Are we in an AI bubble? Picture this. A tech giant announces a $100 billion investment in artificial intelligence. Stock prices surge. Investors scramble. Critics cry bubble. Sound familiar? Welcome to 2025, where the question everyone's asking isn't whether AI will change the world, it's whether we're repeating history's most expensive mistakes. Here's what makes this moment so unsettling. We've been here before. The dotcom crash. The housing crisis. Each time, fortunes evaporated overnight. Each time, the warning signs were ignored until it was too late. And now, with AI valuations reaching levels that would make even the most optimistic investors sweat, we're left wondering, are we witnessing genuine innovation or just another bubble waiting to burst? Let's cut through the hype and examine both sides of this trillion-dollar question. The case against the bubble. Why this time might actually be different. Remember the late 90s? Companies with nothing but a .com in their name were valued in the hundreds of millions. Pets.com famously burned through cash selling dog food online with zero path to profitability. When reality hit, thousands of companies vanished virtually overnight. Fast forward to today, and the landscape looks fundamentally different. The money flooding into AI isn't going to untested startups with flashy names and empty promises. It's coming from some of the world's most established, most profitable companies: Google, Microsoft, Amazon, Meta. These aren't desperate gamblers betting on a dream. They're trillion-dollar giants with massive cash reserves reinvesting profits from already successful businesses. Take Microsoft. They're not mortgaging their future to fund AI. They're using cash flow from cloud services, productivity software, and gaming divisions. Google isn't taking on crushing debt to build new models. They're allocating profits from their advertising empire. This creates a completely different financial foundation than what existed during the dot-com era. And here's the critical distinction: AI is already useful. Right now. Today. Millions of people use it daily for writing, coding, image generation, and automating workflows. Companies are seeing real productivity gains. The technology isn't some distant promise. It's actively saving time and, in many cases, saving money. Research shows meaningful applications across industries, from healthcare diagnostics to manufacturing optimization. The infrastructure supporting this revolution is also built on solid ground. Unlike the 90s, when startups were inventing entirely new systems from scratch, AI is constructed on top of established cloud computing networks, global data centers, powerful processors, and decades of software innovation. If individual projects fail, the underlying infrastructure doesn't disappear, it gets repurposed. Perhaps most importantly, these aren't speculative plays with imaginary profits. Analysis shows that major tech companies are generating 3 times the cash flow relative to their valuations compared to the dot-com era. Nearly half as many technology companies are unprofitable now versus the late 90s. The financial fundamentals backing these investments are demonstrably stronger. The case for the bubble. Red flags investors can't ignore. Before we celebrate the new AI-powered future, let's examine some deeply troubling patterns emerging in this space. Studies reveal that approximately 95% of companies attempting to integrate generative AI reported zero improvement in productivity. Some actually got worse. Only about 5% saw positive returns. Think about that ratio. For every company successfully using AI to boost profits, 19 others are burning money trying to force-fit technology where it doesn't belong. Then there's the profit problem. Companies leading this revolution aren't making money from it. OpenAI, the industry leader, was recently valued at $500 billion despite generating only around $13 billion in annual revenue, and losing billions more in expenses. Running large language models is extraordinarily expensive. Every prompt requires massive computing power and electricity. Experts estimate these companies would need $2 trillion in annual revenue by 2030 just to break even, more than Microsoft, Meta, Alphabet, Amazon, Apple, and Nvidia's 2024 revenues combined. The circular financing arrangements are equally concerning. Nvidia invests $100 billion in OpenAI, who then uses that money to buy Nvidia chips. OpenAI announces a $300 billion deal with Oracle for data center capacity. Oracle then buys chips from Nvidia, who's invested in OpenAI. AMD supplies OpenAI with stock warrants in exchange for chip purchases. Microsoft invests billions in OpenAI, who pays it back for cloud services, which Microsoft uses to buy more Nvidia chips. It's the same money circulating in loops, with everyone recording these flows as revenue, inflating stock prices. Some analysts compare this to vendor financing schemes that became popular during the late stages of the dotcom bubble, essentially, paying your customers to buy your products. Here's another red flag: the gap between promise and reality. AI was supposed to be revolutionary. We were told it would achieve artificial general intelligence, machines thinking and reasoning like humans. What we actually got are impressive image generators, video tools, and chatbots. Useful? Certainly. World-changing in the way investors expected? Not yet. Even the best examples feel like incremental improvements rather than paradigm shifts. Enhanced search features are better than old methods, sure, but not 100 times better. Just slightly better. If this represents the peak of what billions in investment can achieve, serious questions arise about whether the technology justifies its valuations. The concentration risk nobody's talking about. Here's what should genuinely concern everyone: concentration. Currently, 35 companies account for 99% of all AI spending. 2 companies purchased nearly 40% of Nvidia's chips. 10 companies, mostly AI-related, represent 40% of the S&P 500's total value. This creates systemic vulnerability. If one major player stumbles, if OpenAI defaults on debt, if Microsoft's AI investments don't materialize as planned, if regulatory hurdles emerge, the ripples could trigger market-wide disruptions. The failure wouldn't be contained to just technology stocks. There are also physical bottlenecks emerging. Building electrical grid infrastructure takes years of planning and regulatory approval. Data centers require consistent, massive power supplies. Some companies are already skirting regulations to set up generators just to meet electricity demand. The hardware itself presents challenges. With new, faster chips released annually, the assumed lifetime of data center equipment may be far shorter than companies are disclosing to investors, meaning replacement costs could be significantly higher than anticipated. So what happens when it pops? If we are in a bubble, and it does burst, history offers 3 possible scenarios. The optimistic outcome resembles the dot-com aftermath. Yes, many bad companies received too much money. But the bubble also financed Google, helping transform the internet into a genuinely productivity-enhancing technology. The fiber optic cables laid by companies that later went bankrupt still got used. Society benefited from the infrastructure even after investors lost money. The moderate outcome looks like 2001. A relatively mild recession lasting less than a year. Stock market corrections. Some job losses, but nothing catastrophic. The key difference is that today, far more households participate in markets through retirement accounts and mutual funds, meaning pain would be more widely distributed. The catastrophic outcome mirrors 2008. While AI stocks aren't mortgages, and banks aren't as heavily exposed as they were to housing, we don't fully understand how the financial system would react if massive tech companies defaulted on debt. Current analysis suggests large technology firms are increasingly relying on borrowing to build data centers for demand that doesn't actually exist yet. That's concerning. The verdict. So are we in an AI bubble? The honest answer is, probably, but with important caveats. Multiple fund managers believe valuations are inflated. The International Monetary Fund and Bank of England have issued warnings. Even OpenAI CEO has acknowledged we're likely in a bubble. The patterns are there: massive spending chasing revolutionary technology, valuations approaching dot-com era levels despite limited profitability, circular financing arrangements propping up demand. But this doesn't necessarily mean we're headed for disaster. Unlike previous bubbles, the companies driving this build-out have strong balance sheets, limited debt, and cash-generating businesses supporting their investments. The technology is delivering real value today, not just promised value tomorrow. The infrastructure being built won't vanish even if some companies fail. Investment strategists point out that industrial bubbles, ones that leave behind useful infrastructure and technology, are fundamentally different from financial bubbles. When biotech bubbles burst in the 90s, companies lost money, but society got life-saving drugs. When the dotcom bubble popped, companies went bankrupt, but we kept the internet infrastructure. The AI bubble will likely follow this pattern. Some companies will fail spectacularly. Investors will lose money. There will probably be a recession. But the technology being developed, the data centers being built, the research being conducted, that doesn't disappear. It gets absorbed, repurposed, and ultimately benefits society even if initial investors don't profit. The real question isn't whether there's a bubble. It's whether you're positioned to weather what comes next and whether the world being built on the other side of this bubble will be worth the cost of getting there. If you enjoyed this video, like, share, and subscribe. Thank you.